Hi, I'm Ed Usalis. I'll be presenting kind of the first half of our slide deck today. Before we even get started, the common thread that's going to run through our presentation, or is probably the most important thing that you take away from this, is expectations. Both setting them, managing them, and of course meeting the expectations. So those are that's kind of the common theme that's going to run through, and those are, by meeting those expectations and setting great expectations, is how you're going to manage and enhance the value of any business, whether it's a startup or not. So the first question that we often get from a startup community is, how are startups funded? And the vast majority of startups are self-funded, either through personal savings, family and friends, so family, business acquaintances, and close friends. And very few startup companies, and this list was compiled by the Inc. 5000, of the 5,000 fastest growing companies that they've identified. You'll notice that very few have relied on venture capital, angel investors, business acquaintances, maybe outside investment, maybe family and friend money. But the bulk has relied on personal money of personal savings, credit cards, family and friends. So while that may appear daunting, there are a remarkable number of success stories with small companies. And this chart will basically show you how various companies that we all recognize today started their initial pitch, or started their initial company. Hewlett-Packard started with $538. Obviously, that's not inflation adjusted, but Hewlett and Packard in their garage in Palo Alto had all of $538 in their pocket when they started. Threadless, kind of the hip clothing company, and Dell both started with $5,000 in the bank, or $1,000. Spanx, the women's undergarment company, with $5,000. American Apparel with $10,000. And then it's not until you get to Whole Foods that they relied on any outside or borrowed funds. So Whole Foods started with a total of $45,000, of which 10 of that came from the founders. Under Armour, the sports apparel company, had $20,000 of personal money in it. And then GoPro, which has been in the news a lot lately due to their valuation, had $64,000 in investor or personal money and $100,000 in outside debt. So basically, it's showing that regardless of the investment size at the startup, you can grow into the next Hewlett-Packard, hopefully. So how did you get here? Well, if you're an entrepreneur, you've basically identified a problem, and you've looked at the problem and said, gee, there might be others in the world that are having the same problem, and I might be able to solve this problem. In identifying the problem, there's a great book called 0 to 1, and I talked about it with a couple of you this morning. In that book, the whole startup focus is, you don't want to be the second Google. You don't want to be the second Microsoft. You don't want to be the second Medtronic. You want to come up with a new, fresh idea. So you develop the market from 0 to 1. You're the first. So in identifying the problem, you're going to go through a lot of different things, different thoughts, different analyses before you even get off the ground. And we just put this graphic up here because these are a lot of the things that are probably running through your mind as you're a startup or analyzing an early stage company. Have they done market research? Do they have analytics and analysis? There's that great idea as well. Profitability analysis and calculation. That might be a market assessment. You've got this great idea, you've got the solution to a problem you think a lot of other people have, but is there a market for it? And without the market, your great idea might just be that, a great idea. Other things that are very key in helping set the expectations are the project team organization. A lot of you may be solo practitioners where you're trying to build it on your own. Some of you may be in the process of forming a team or putting together a team or expanding a team. Bob will go into that a little bit later on when you put a sales organization into place and how that can help you. Obviously, hard work. Public relations, obviously you got to get the word out to your target market, making sure that there is a market, identifying that kind of ties back into the market research and the analytics. The achievement of the target, achieving your expectations, the expectations that you've set. And, project started, basically means you're getting some traction. So these are all the things that, as valuation people, we look at in the startup, when we're evaluating startups. Have they done these things? A lot of times, and Bob will talk about this a little bit later, they're extremely strong in one of these areas, but have kind of ignored the remainder. And a lot of times, unfortunately, entrepreneurs will also get hung up on their idea of it's a great idea. There must be more people that have this, but they've done nothing to validate their process or their idea. So this is from Startup Commons, website kind of tailored to the startup community, and has a lot of great tools out there. But basically, this is the timeline that you're going to follow. And it's very interesting. We use a -2, and that really you're at the infancy. This is the idea stage. You've got the problem. You're trying to find a solution that'll fit that problem. As you move forward, you might establish a more coherent or concrete vision for what you're trying to do. And then at stage 0, you kind of have the commitment. That's where you've identified the market. Yes, there's something to move forward here, and for the idea and the solution to move forward. So then we get to stage 1. And if you're familiar with the startup community, the minimal viable product, that's where you're coming up and saying, gee, I want to get to market quickly. I want to get there with a minimal viable product to test the market, to make sure that there's market reception, make sure that the market will acknowledge that you've identified a problem that needs to be solved, and you now at this point have a prototype, maybe a rough prototype of your product or service. This now moves into the validate and iterate stage, where the prototype got traction, but yet there's a few things lacking. The market has responded and asked for something different than what you've provided the market. That's where you may iterate or pivot. And then at stage 2, you're beginning to scale. You've said, I've got a viable opportunity or idea. How do I roll this out to the Greater Twin Cities market? How do I go national? Whatever your market goal might be. And then at stage 3 is where you're becoming established, where you have market traction. The phone rings on its own at times. You're not necessarily having to pound the pavement to get people to respond to your product offering. And then obviously at the end, you're growing and expanding. The one piece that I've ignored in this is that red line that's dotted at the early stages and then becomes solid as it goes forward. In discussions, that's really a representation of value. It's dotted from stages -2 to 0 because there may or may not be value there. If you have no market traction, no market guidance, your idea might just be that, a great idea. And it really doesn't cross positive until somewhere between stages 1 and 2. And that's where other people are looking at the idea or value proposition or solution that you're putting forward and saying, yes, we believe this might have value as well. So, but throughout this continuum, you do need funding. You do need money to keep the lights on, to keep iterating, to keep doing the market research, the analytics, all the things that are going to make the startup flourish. So since this is a discussion about valuation, we wanted to talk about the traditional valuation process, because that's, Bob and I started out doing valuations of established companies. That's where all of us in the valuation world have cut our teeth. And I'm not going to walk through every box, but it's an involved process. So we'll get an engagement, and you may have an aha moment of saying, but my startup doesn't have any of these, and that's where we'll go into the unique challenges of startups. So we'll get the engagement. One of the first things we're going to look at is historical financial statements, income statement, balance sheet, statement of cash flows. How has the business actually performed, the established business performed? We're going to analyze those, look at some ratios, profit margins, conduct a site visit, making sure that everything fits together. We may adjust the financial statements, i.e. for certain things like owner's comp or lack of owner's comp, where a founder or startup has not taken adequate compensation for themselves. And then it's really not until the yellow boxes that we get into the appraisal process, and we'll go in a little bit deeper into the various appraisal concepts. And then we come up with our conclusions and issue an appraisal report. This appears very straightforward, and for established companies, it usually is. They have their business operating documents, they have their financials, they have the reports they use to run their business. So that's why valuation of established companies really falls into three baskets of traditional valuation methods. The asset approach. It's a sum of the asset values. It's the chairs, it's the tables, it's the CNC machine in the factory, it's the inventory. It's also, if you're a startup in the software space or more of an intangible area, it may be hours spent times the labor rate to develop, 100,000 lines of code or more, or 1 million lines of code. So the asset approach is basically a sum of the asset values of what could it take to either replicate or rebuild what I've established here today. Not necessarily used a whole lot for going concern businesses. Asset approach sometimes will assume that there's a liquidation or you're not going to make it. But it is applicable on certain occasions. The next one is the market approach. Market approach is a metric times a multiple. And I'm sure everybody's heard that all established businesses sell for between 6 and 8 times EBITDA. Not necessarily true, but that's something that's thrown out there a lot. Some companies sell on a multiple of revenue. Some companies sell on a multiple of cash flow. And then finally, the last approach is the income approach. And this is for companies that have projections that say over the next 5 years, I'm going to make X, or X plus in each of the next 5 years. So the income approach is basically the present value of those future benefits, whether it be cash flow, EBITDA, net income, but some metric that we can bring back to present value. And in that regard, it's great if you have projections and you have an established business that we can look back and say, yeah, you've grown 8% compound annual growth over the last 5 years. That's great. We can forecast that into the future. But again, you're a startup. You probably don't have that. So how is a startup different? And I kind of covered some of these, so I'll run through these pretty quickly. An established company has revenue and an earnings history, an established customer base, an accepted product or service, proven success, and stable future growth, hopefully. Now, a startup has no revenue or earnings history. May be a black hole at this point. It may just be taking money rather than generating money. Few or no paying customers. It's testing a new product or service. It's validating the market. New processes are being employed that we don't necessarily know if they're going to result in future positive cash flows. And then finally, there's a high growth expectation. So this is why most of what I've just talked about doesn't apply to startups. So Bob is going to take over and kind of delve into valuation of the startup.
So I'll reiterate what Ed just said about expectations is the expectation of an established company is that it's going to continue to grow at a certain level. It's going to have a fairly stable set of cash flows, and there's an expectation of a future. The expectation of a startup, at least from an investor standpoint, it's got to have high growth expectation. It's got to have an opportunity that's being met, or a new opportunity that's being met in the marketplace. So valuation of an early stage company involves a lot of qualitative factors, a lot of things that an investor is looking at that may not necessarily be quantified on an item-by-item basis, but needs to be taken into account. So the representation here is kind of from a lot of people that are in corporate or have been in corporate. Remember the dashboard systems of green is good, yellow is marginal, and red is danger or bad. So in this case, green being good from a viewpoint of what's established, red being hasn't been established yet. You see that in this example, some of the things of this business are identified, nailed down. There's an idea, there's an industry and a market opportunity defined. There's a founder, or at least one founder, maybe more. There may be advisors, and there's been money spent and hours invested in the business. Those are all positive things that obviously need to be kind of at the base level of any business. Looking at some of the things that are in yellow, at this point, a prototype may or may not have been developed. There may be marginal number of users or customers. You may be still in a proof of concept stage. So a lot of these things that are in kind of in transition need to be considered as, at the point in time when the company is looking for funding. How far along is it? Has it proven itself? Has it invested enough time and effort? Has it acquired the right team members and the right sales team, sales plan in place to go forward? And then red, those are kind of the later stage things that occur. Patents may be secured early on, but in this case, the example shows that your IP hasn't been protected. So if there's some kind of a patent process that needs to be started and it hasn't been, that could be a negative from a standpoint of valuation, because you're not, anybody else could come in and take your IP and or modify and improve upon what you've done. A revenue model and defining gross margins. Obviously, if you don't have customers and users, you might not be able to define what your revenue model is. But by the time you're out for funding, you got to have some kind of a viewpoint of what your revenue expectations are near term, meaning in the next 12 months, and hopefully for 2 to 3 years beyond that as well. So drivers of valuation, and I'm talking again just on early stage. This really applies to all companies, but for an early stage company, the stage that the company's at, is it at that -2 that Ed was showing, or is it at +1? How far along is it? How many things have been developed? How much time's been invested? Has the opportunity been vetted, and is it an attractive opportunity that's going to meet a market need? Does it have high growth potential? If it doesn't have high growth potential, that your investors will be someone other than angel investors and other than venture capitalists. And we'll get into why those high growth expectations need to be met for that type of investor. Competition. If there's more than one investor that are interested in your company, obviously your value can increase based on just supply and demand. You got people competing to fund you. Value could go up for that alone. A strong team is probably should be up right after stage of company in terms of order of importance. The ability of knowing that whether a company is going to succeed or not is somewhat of a crystal ball and somewhat of throwing the dice. You can foresee success based on past success, but there's so many other dynamics in the marketplace that are affecting a team that even the best team may be challenged by the market opportunity and by the economy. Just skipping down below here as far as exit potential within the target time frame. If you're talking about, again, an investor that's either reporting to limited partnerships, or limited partners, such as a venture capitalist, or an angel investor who's investing their money, or a group of angels, they typically have a time frame of 5 to 7 years that they want their money back. And so can your company be ready to exit, and that means be sold to someone else or transitioned to a different, maybe a strategic investor within that time frame. The last one is the current economic environment. If you're in a recession or if you're in a downturn, there may be a clamping up of investor funds. So obviously the opportunity happens when there's funds available. So from some of the data that we observe, there's a Pepperdine cost of capital study that comes out about annually, and it surveys a number of different lenders and investors and tries to get a sense of how much is your expected rate of return, all the way from a bank loan. An asset-based loan is just a riskier bank loan. Mezzanine financing could be bank or investor debt financing. Private equity, venture capital, and angel investors. And as you can see, the trend line is generally upward. It really, if you look at this 2 years ago versus today, it's still going to have the same general bend to it. You might start at 5.2 or 5.6%, and it might, be in the 32 to 30 or 52% range on the high end. So it's generally, that kind of a trend line. And what we're talking about today in terms of I don't want to say software only, but a technology-based company or an early-stage company that has some kind of a high growth potential, where you're targeting your venture capital and your angel investors, that expectation of return is somewhere in the 30% to 50% range of annual return on investment. So these numbers are probably too hard to read in full depth, but really what we're talking about here is a sample venture capital portfolio. And if you think about the venture capital investor, he's responsible, his fiduciary responsibility to return funds to his limited partnerships over a period of time. So when he collects his money for funding, he wants to spread that over a portfolio of 10 or more investments for a 5-year time horizon. In this example, we're going to use a 5-year time horizon. So investing $100 in 10 separate investments, all of which this investor expects to have a great payoff from day one. Typically, you'll see that over 5 years or less, 5 of them or so will completely, they'll fail. They will either close down, they'll transition into something else. There will be zero payoff. Maybe another 2 might get half your money back. And the remaining 3 have a positive return, but really number 8 here, 8 here is a 2x return, which means if you put in $100, you got $200 back 5 years later, which equates to 15% annual return on investment. If you think about getting a 15% annual return on investment for 5 years in the stock market, you'd probably be happy. But as a high-risk investor, that's a fail. So only the last 2 investments in this portfolio really get home runs of 30 or 50 times return, which overall, these 2 investments carry the portfolio with an annual return of 50%, 54%. And that equates to an 8.7x return for the portfolio as a whole. Now, hopefully that explains why those venture capitalists expect a 50% return on their money. Is they don't think they're going to get 50% return on every one of those, and they don't know which one of those is going to be the big payoff. They're betting on every one of those investments as being possible to be a success, but they're not the predictors of the future to know exactly which ones will be. This is the same set of data I'm just showing in a graphic form with investments 1 through 8 pretty much being the flat line, 9 and 10 being the payouts, and the total cumulative value being your 8x or 8.7x return. So from a venture capitalist or angel investor's perspective, and I'll use both of those kind of combined because they both have a lot of similarities in terms of expectations. They are investing on a high-risk investment and expecting high return. It's an illiquid investment. They'd like to be in and out within a very specific time frame, 5 years, 6 years, 7 years. Sometimes that time frame changes because the company's not ready to exit. But it's illiquid at that point, at any point. You're not going to be able to go to the market and sell your investment like you can with a stock or a bond. High failure rate, we already went through that, and success is unpredictable. So any one of those investments could be a home run. Many of them won't be. So just to reiterate, from a return on investment standpoint, like I said, the 15 to 20% return, that's great for a stock market investor. That's a 2.5x return on an investment. That's not acceptable for an entire portfolio. The entire portfolio needs to be somewhere in this 60 to 100% annual return on investment over 5 years to be able to get to the range that you're looking for a successful venture fund. This is pretty much saying the same thing, that 8.7x is what we were talking more about to get a 54% return on investment. You're going to need a couple of them, a couple of those investments really big on this end to take care of all the ones that are below that on this end. So now let's do some math. We've held off until now, and it's not going to be too in-depth, but it'll give you at least an understanding of how value gets defined or determined. How many people are not familiar with the term pre-money and post-money? Okay. So when you're trying to establish what your company's worth, or what an investor is trying to determine of what it's worth, they're going to start from the future and work their way back, because they're looking at, what can I sell this for when I exit? And so in order to determine what you can sell your company for in the future, you need to work your way back to what it's worth today after the investment has been put into the company. So before the company has received funding, the value is pre-money. It's what's it worth before the money. Plus the money, plus the investment, gets you to post-money. So now we're going to work our way backwards. Post-money, to get to post-money value today, we start with what's it worth 5 years from now, and divide it by our, let's say, a 20x return multiple is what we're going to assess every one of our investments at. We've got to be convinced as an investor that we're going to get 20x on our money on every investment, because we don't know which ones are going to do well and which ones aren't going to do well. And the other assumption here is we're going to assume that the investor or the company needs $500,000 investment today. So one approach, which Ed mentioned, was a market multiple times a metric. So the metric, we don't have revenue today, but 5 years from now, we hope to have $20 million of revenue, because we're going to grow from 0 to 20 in 5 years. Or that's what the investors' expectations are based on what your market opportunity defined is and where your team's going to take it. So one metric is to take a multiple that's expected, and in this case we're assuming a software company, and the subsector that software company is in has a 2x multiple of revenue out there for deals that have been done, for transactions in the most recent time frame. That's the expectation in the future as well. So with that market multiple times metric, we get a $40 million value 5 years from now. Another multiple would be to take what your earnings are 5 years from now times a multiple. Again, expectation of a 15% bottom line after tax return, a 15x PE multiple, gets you $45 million of value in the future. So between these two approaches, we get somewhere between $40 and $45 million. We're going to say 42.5 for now, and that's kind of a typical thing that valuation folks do, is they'll look at it from as many possible valid approaches as possible, and then say, okay, how much weight am I going to put to one to the other? So in this case, we're going to just take it in between, divide it by the ROI multiple of 20 times, gets us a post-money value of $2,125,000. So that's what the post-money needs to be today in order for those investors to get their 20x return 5 years from now. Post-money is then obviously after the investment, so backing out the investment gets us to a pre-money value of $1,625,000. So that's what this particular company would be valued at by an investor today, based on all of the expectations and information that they know as of today. That number could change monthly, as progress is made. It can change, go upward and downward depending on what the market is doing in terms of venture investments. But that's kind of in a nutshell where how the pre-money is determined. Any questions? These are if you look in the public markets, and you look at like a subsector of an industry, and says what are the market multiples that are observable, the 2x could range anywhere from 1.5 to 3.5 or whatever, and maybe the median is at 2 or whatever. The selection is made by kind of the person that's deciding how aggressive do I want to be on that. Same thing with that's a PE multiple. There's observable PE multiples. So in the public markets, there's observable data, and then from a transactional standpoint, some transactions are there's enough information disclosed in them that you can derive that information as well. Yeah.
And sorry, could we use a microphone just so everybody can hear?
Bob, do you take family and friends investment into this calculation, or are you talking about seeking new money that might be from an angel or a VC?
I think that when you look at the chart that shows the expected returns, there isn't. They haven't surveyed family and friends investors. They're kind of like that's like you and your closest people are going to have an expectation of maybe survival.
One of the 17 startups that I'm working with has already, through friends and family and founders, invested $500,000 in the business. So I'm looking at your later chart slides where you're talking about pre and post money valuation. My question is, can the $500,000 be considered as post-money versus pre-money?
Correct, because the pre-money valuation would be the $1,625,000. So that would represent the investment of the family and
So if they've only invested $500,000, should that then mean that the pre-money valuation is the $500,000?
no, the 500,000 may have grown to the $1,600,000.
Yeah, if they originally invested 500,000, and that's the only money that's been invested so far, and they own the entire company so far, that has grown to $1,600,000. That implied value that's what the company's worth before any new money comes in.
Could we take a deeper dive into the $20 million in revenue from the early stage tech company? For a tech startup that's 6 months in the making, I feel like predicting 5 years in the future is a little difficult. I can project astronomical revenue growth. I could say I make $100 million in 5 years, but how do you analyze that? How do you assess the market opportunity?
Well, depends on how far along you are in your development of, have you defined users, and do you have paying customers? And once obviously that knowledge of the future becomes a little bit more clear, but never perfect, and projections are always going to be wrong. But the expectation is realistically, and there's a lot of companies like this, that once you've started with some level of revenue, whether it's $50,000 in year one, the first 3 or 4 years of traction are going to be 100% growth, or is significant. It's going to be 3-digit or high 2-digit percentage growth. So to get from 100,000 to 20 million in a doubling effect or quadrupling or tripling effect can happen fairly quickly if there's that scaling that's going on. To define it, to know it for sure, yeah, it's never known for sure, but it's the market capable of being, is it the opportunity that big that they can grow into that much space? So it comes back to defining your total addressable market, and then, you know, how are you going to unseat the players in that market so that you can grow into that level of revenue growth.
And I guess one other thing, I'd call this the Shark Tank fallacy, where you've seen the show Shark Tank. Well, it's a huge market. If we go in and we just capture 1% of it, we're going to be huge. Well, that's not doing the initial research up front of saying, yes, I've got this product or idea. I'm going to get this level of adoption. This is the market size. So the $20 million of revenue in year 5 is reasonable. It may not be spot on right, but it's reasonable that you have a basis of how you're going to get there.
I would just say that the pyramid that you had up there before, if you went back to the pyramid, just to answer your question, you want to build on the strength of the other blocks. If your other blocks are very strong, then you're going to have a lot of confidence in your 5-year forecast.
And also, bringing up the blocks, this is basically from a variety of sources. When venture capitalists, angel investors, they're going to go in and they're going to basically kick the tires on each of these blocks and say, your users, your customer base isn't necessarily very well defined. Your business plan hasn't been coherent or established, written down in paper or followed. So basically, yeah, the goal is, as Bob said in his presentation, part of the presentation, you want to get as many boxes as you can in green so that they can withstand that scrutiny. And believe it or not, the more boxes that you have are green, probably the higher value you're going to get.
As I said before, the purpose of me visiting this class is to really understand how I can value our company in terms of ownership and splitting it up between partners. So would you recommend doing this process for that and then doing a discount, or just looking at it exactly like this to determine how one partner could increase ownership value by buying it?
I think from, you know, a partner or a co-founder standpoint, you're looking for a different type of commitment than an outside investor. You're obviously, a lot of that sweat equity, time, and effort is being invested versus maybe significant dollars. So in terms of where you are in your stage of development will determine how much your company, you know, how much of the value should be shared with that person. It's a little bit more difficult to, you know, define value when you're talking about someone coming on board for a specific, you know, if you're looking for them to come on board to help you develop something versus come on board because they've got, you know, some money that it's going to, you know, cause your runway to go for another year, that's two different things. So is it an investor or is it a founder? Is the founder bringing expertise that you don't have to the table that's going to help you carry the business forward? Then maybe value specifically does not need to be defined yet. Maybe it's a percentage of ownership that needs to be negotiated because of, you know, just relative, you know, I'm bringing this much to the table, you're bringing this much to the table. Let's figure out what's reasonable.
Yeah, we've started that process, and so what we're hoping to do is come up with a formula to continually evaluate this process on a yearly basis. And so our CPA told us, well, you just need to have a language in your membership or your partnership agreement, what have you, that gives you that valuation opportunity on an annual basis.
When you set a formula, Bob and I probably both physically cringe.
Yeah.
Because a formula is, I mean, in my presentation I said, there will be people, business brokers, there will be people, bankers, not to pick on anybody, but they will tell you that every business sells for between 6 and 8 times EBITDA, which is not true, and that's a formula. The problem with a formula is a formula may work great today, but as your business grows, expands, evolves, gains traction, the formula, I guarantee you, does not grow with the business. The static formula, I mean, it may be great to bring on a founder today, but let's say the business takes off phenomenally, and at some point you're like, boy, yeah, 3 times revenue was not the right multiple to put in the agreement. So that's just the only caution I'd give you.
I would also chime in, when you're working with a founder or a co-founder that's going to be with you for a period of time, and your lives are intertwined, but also you have separate lives. Things change between, that stage where you're all excited about something and 2 or 3 years down the road when you've pivoted twice and you're not sure which direction you're going. The definition that you've set up at day one, you've negotiated something at day one, and that may change over time. It's better to renegotiate it down the road, as opposed to holding yourself to some kind of a legal agreement that says we're going to define our ownership interests or our value or anything by this formula that we're kind of locked into. So I would recommend, especially with founders and people that are contributing to your company, just like if you're hiring your first sales director, you might be negotiating something beyond salary. You're going to give them stock options or something. It's going to be a negotiation of what's fair as of that point in time, and it gets renegotiated as things change.
That's all the time we have for questions. We got to wrap up because we have 1 million cups starting right after, and I want you to have a little bit of time to network and talk with Bob and Ed offline here. I'm sure they have contact information that you can follow up with them on questions. Also, thank you both so much for being here today and helping us understand valuation companies.
Thank you.